Vladimir Putin's own special advisor just accused the US of trying to shove its $35 trillion of debt into stable coins as a means to devalue it and reset the entire financial system. So is America weaponizing crypto to export its debt problem to the world? And if that's true, what happens to banks and to the trillions in stablecoin demand that now sits in US treasuries? And where does Bitcoin fit in this clash between nation-states, banks, and the future of money itself? Welcome to No Second Best, the show where conviction meets reality and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. Bitcoin has continued consolidating sideways early this week, still bouncing between 110 and 113K. But what's amazing is that this price action is holding even after whales sold off more than 12.7 billion worth of Bitcoin in the past 30 days, the largest sell-off since 2022. The fact that we're over $110,000 with that much selling pressure is a testament to the strength of this market. And meanwhile, gold just keeps on notching fresh all-time highs almost daily. And Morgan Stanley now expects continuous rate cuts all the way through 2026. So liquidity is very likely coming back into the system soon and will continue flowing for the foreseeable future. And in the middle of this amazing market setup for Bitcoin, Russia just accused the United States of using stable coins to erase its $35 trillion of debt. Here's Anton Kobyakov, special advisor to Russian President Vladimir Putin, saying the quiet part out loud just a few days ago. Option alternative. Formable. This bombshell statement from Russia comes shortly after President Trump signed the Genius Act, the first federal crypto law, which requires stable coins to be backed one-to-one by U.S. treasuries with full audits and compliance, which means every new digital dollar in circulation equals one more buyer of U.S. government debt. So, technically Russia isn't wrong about the mechanics. The U.S. has found a way to increase demand for U.S. treasuries and in turn, make its debt someone else's problem. And it's definitely not just Russia pointing this out. Dave Collum, a Cornell professor and outspoken critic of Bitcoin, recently joined Natalie Burnell's Coin Stories podcast. Now, he's no Bitcoiner. In fact, he's deeply skeptical. But listen to what he says when the conversation turns to stable coins and U.S. debt. We've seen moves with even Bassan and a lot of the political leadership embrace the digital assets industry, establish this strategic Bitcoin reserve. They haven't announced plans of how they're going to accumulate, but they're really going in that direction. And they prioritized stable coins because who's going to buy our debt? Stable coin issuers, right? They're going to be mandated to hold short-term treasuries. And so I think, doesn't that spook you? Well, no. Why? Well, the stablecoin is just essentially a digital dollar. And I think it will Bitcoin adoption. Now, Colin went on to bring up his often repeated fear of government enforcement on Bitcoin and Bitcoiners, and the discussion was interesting. So, check out the full interview. I'll leave a link in the description. But even a critic like Colin sees the danger of what the US is attempting to do with stable coins. They aren't just a digital dollar, they're a pipeline that forges global demand into US treasuries. But here's what he misses. This isn't the end game. And so, it doesn't spook any well-researched and seasoned Bitcoiner. Stable coins may buy governments time, but eventually the free market demands harder reserves, and that's exactly where Bitcoin comes in. To explain this in more depth, here's Eric Yakes on the Bitcoin Infinity podcast laying out the game theory of banks, stablecoins, and Bitcoin. Stablecoins are going straight to the source now. Stablecoins are saying, we're going to buy debt, and we're putting it behind a stable coin. And that's like cutting out the rest of the system right now. It's cutting out central banks, it's cutting out the commercial banks, and the Genius Act when it passed in the US to give a regulatory framework for stable coins. That act it's just a regulatory carve-out to try to protect the banks is all it's doing. It's saying stable coins, you guys can't pay interest to people. Only banks are going to issue their new CBDC, stable coins called tokenized reserve deposits. And what stablecoins are doing is they're basically creating a token that's blending the US debt in the same way the dollar does by having a bunch of different maturities and bunch of different vintages, and it's making it more fungible. One stablecoin is representing one, and the market kind of determines that based on how they're reserving the thing. And we have this new banking system emerging around that. How does a game theory play out? We're going to have a whole offshore market that emerges for these stable coins because now that we have regulations in the US, those regulations are saying you can only use short-term government debt and you can't pay interest if you're issuing a stable coin. It's going to make them a lot less sexy to people. What's going to be sexy is the offshore market, and that's going to be like we're paying interest and you can reserve with what you want to reserve, and a competitive market's going to determine what that is, and you don't have to deal with all this banking cartel bull. So that's going to emerge, and whether it emerges directly for dollars or for other currencies, we're going to start to witness that play out with stable coins. And what are they going to be competing on? What do we know from participating in all of these like fiat games that have emerged in broader crypto? Yield. Everybody wants some sort of yield. The biggest thing is that when you're competing on the interest rate, it's going to come down to what are you reserving it with. So if we look at how Tether is reserving Tether today, 5% of their reserves are in Bitcoin. And Tether's like arguably the most profitable company in the world right now because they don't have to pay the interest out yet because the market's just not competitive enough to require them to. So they basically just get to keep the money. But if Tether was paying out interest, it could be paying a lot of interest for everybody that's holding the stable coins. And that 5% Bitcoin reserve, I think, is going to become a really key thing. When people say stable coins are like a Trojan horse for Bitcoin, it's like, what are they doing? They're putting the world on infrastructure that's going to be transacting in cryptographic signatures. So that's big. And then they're going to create an incentive where the token that's paying the best interest is going to be the token that's reserved most competitively. What's going to be the best reserve? Bitcoin. Bitcoin. And so what's Michael Saylor doing right now? Yeah, that's basically what he's issuing. His stock is that kind of token. Exactly. So they're just doing it on rails that you can actually trade it with as opposed to a brokerage account for somebody. But the economics of what he's structuring, that's going to be like the end state that happens with all these things. So stable coins are going to be basically co-opting like a Saylor strategy over time. And that's going to create a ton of demand for Bitcoin. And then everybody's going to be sitting here. And what is that going to do? It's going to jack up the price of Bitcoin. Bitcoin is going to be trading at 20 trillion market cap, whatever it is. It's going to be significantly less volatile. It's going to be much more mature. And everybody's going to say, are we trading in stable coins? We just trade in Bitcoin. And that's like what I'm excited about thinking through how all this works, is that's the game theory that leads us to Bitcoin adoption in the way that the market currently works today and how institutions and governments think. Yeah. And Tether's 5% reserve will all of a sudden be 50% reserve because of the increase in value. Exactly. And it's just going to be like, all of the other stable coins who aren't using Bitcoin reserves are going to say we can't compete with the guys who have 20% Bitcoin reserves. We need to do it, and people are going to keep jacking it up. So, this is the long-term game theory that most national leaders, traditional financial folks and skeptics like Column seem to be missing. Stable coins create demand for U.S. treasuries. They bypass the old banking system. They even look like a new form of dollarization, but the competition for yield eventually forces issuers to hold better reserves. Offshore stablecoins will pay interest. And as Yakes points out, the ultimate reserve asset is Bitcoin. So, ironically, the same mechanism that Russia warns about and the US is exploiting will very likely greatly accelerate global Bitcoin adoption. Now that we have the long-term game theory in mind, let's zoom back in and look at what the market is telling us right now. As I mentioned earlier in the show, whales just dumped more than 12 billion worth of Bitcoin in the past month. That's the biggest sell-off since 2022, and yet price is still holding above $111,000. That's insane resilience. Meanwhile, Morgan Stanley is saying rate cuts aren't just coming, they're coming every quarter through 2026. In other words, it looks increasingly like the liquidity cycle will be back with a vengeance. And what about gold's historic rise? You'll notice Bitcoiners often cheer on the rise of gold because we know that the higher gold's market cap climbs, the larger the store value market is becoming. And there's another signal here. When gold rips higher, it's telling you people are losing faith in our debt-based inflationary monetary system. That's exactly the environment where Bitcoin thrives. Since Bitcoin is far superior to gold in its monetary properties, every move higher in gold not only expands the addressable market, it also raises the floor for what Bitcoin can eventually capture. And here's where it gets interesting. When you measure Bitcoin against gold, it looks like we're getting ready to break out of a massive 5-year formation. Historically, these kinds of setups have meant 300% moves. Terra Digital's work on Bitcoin correlation to gold points in the same direction. A potential rally towards $167 to $185,000 in the months ahead. And don't forget the big picture. It's not just that Bitcoin is going up. What's really happening is that the dollar is breaking down. This is the chart they don't want you to understand. And this is why we don't get distracted by short-term noise. The game theory is clear. The US and Russia are fighting over stablecoins, but Bitcoin is the asset that actually settles the score. So, to recap, stablecoins might buy governments time, but they can't change the rules of money. Eventually, the free market pushes reserves towards the one asset no state can debase, Bitcoin. And that's exactly why we stay humble, patient, and keep stacking. Because in the end, there is no second best money. But I want to hear from you. Do you think Russia is right that the US is using stablecoins to soft default and reset the global financial system? Do you see it playing out like Eric Yakes laid out with stablecoins becoming a Trojan horse that eventually accelerates Bitcoin adoption globally? And if so, how much of this do you think governments and banks understand? Drop your thoughts in the comments below. And if you got value from this episode, make sure to like the video, share it with someone who needs to hear it, and subscribe.